Most traders fail not from bad entries, but from position size they can't survive. A 30-point move is $150 on one micro contract. A 200-point swing is $1,000. The fix isn't prediction, it's controlled size. MES gives you the same market with smaller, precise sizing. In this video, what MES is, the money math that matters, how traders actually use it, the traps that erase accounts, and one example to see how structure's applied. MES stands for the Micro E-mini S&P 500 futures, and it tracks the S&P 500 index. It trades on the CME, the Chicago Mercantile Exchange. So why does it exist? Standard E-mini contracts are efficient for large accounts, but oversized for most retail traders. Micro contracts give smaller sizing on the identical market structure. When the index is 5,000, one MES contract controls roughly 25,000 notional value, and notional is the exposure you control. MES is cash settled, no physical delivery, and the primary expirations are quarterly: March, June, September, December. Now, the numbers that we'll be using every session. Translate movement to dollars first, then the chart makes sense after. A tick equals 0.25 points, and it's worth $1.25. 4 ticks makes 1 point, worth $5 per contract. A 10-point move is $50. A 20-point move, $100. Event days like CPI, FOMC, NFP, they often swing 50 to 150 points, depending on the volatility. And that means one MES contract sees 250 to 750 of potential gain or loss. At the index level of 5,000, notional is 25,000. If overnight margin is 2,000, leverage is roughly 12.5 to 1. If intraday margin is 250, leverage jumps to nearly 100 to 1. Leverage isn't right or wrong, it's just mathematics. Essentially, align it to your account and your trading plan. The control variable is risk per trade. The smaller or developing accounts operate around 0.5 to 1.5% risk per idea. And here's the sizing formula that prevents accidental over leverage. You calculate position size by comparing your account risk to your stop distance. Then round that number down to the nearest whole contract. If the result is 0, skip the trade or tighten the setup. That single rule prevents 90% of retail blowups. With the maths understood, here's how traders actually use the MES. Number 1, skill drills. Essentially, trade a single contract with a fixed stop and target. Do around 20 repetitions per week. The goal is discipline, not income. As your execution stabilizes, your P&L curve flattens. Number 2, intraday moves. Focus on opening range breaks, VWAP deviations, prior high or low sweeps. Aim for 5 to 10 points per trade. Scale half at 5 and trail the rest behind structure. Number 3, day to swinging. MES runs 23 hours a day. If you hold outside US hours, reduce your size and use a time stop. Overnight sessions in Asia, Europe can move price very fast through your stop. You want rules for that. Number 4, portfolio hedge. If your equity portfolio is long and sensitive to market swings, a short MES can offset that beta during key catalysts like CPI or earnings season. Size the hedge to portfolio dollar exposure, not your gut feeling. One rule across all 4, structure. Use cases mean nothing without risk control. Here's the leverage picture and where traders go wrong. Leverage is equal to notional divided by margin. Margin changes intraday and across brokers, so treat it as a moving variable. At an index of 5,000, one MES controls 25,000 of notional value. A 1% index move, 50 points, equals about $250 per contract. Against $250 in margin, that's a 100% swing on margin. That's why intraday margin often tempts traders to oversize. The entry feels cheap, but the exposure isn't. Also operate by risk per trade and daily loss cap. For most developing traders, 0.5 to 1.5% per idea and 1.5 to 2% per day. And remember, time is risk. If you carry exposure overnight, half your size and place hard stops beyond the structure, not where you hope price will respect. Know the venue and hours so you're not surprised by quiet moves. Cash equities trade from 9:30 to 4 p.m. Eastern. MES runs 23 hours a day on the CME Globex, with a maintenance break from 5 to 6 p.m. Eastern. During Asia and European sessions, liquidity thins and ranges tighten. Stops can slip if you hold overnight, use time stops, and reduce your size. The tool setting costs are also straightforward. Liquidity is strong, between 100,000 to over 1 million MES contracts trade daily. Spread is typically 1 tick, equal to $1.25. MES tracks the S&P 500 almost tick for tick, but its price action is cleaner and easier to read. You'll notice tighter moves and steadier fills because the contract size is smaller. SPY often sticks near round numbers. ETF flows create that sort of behavior. MES trades electronically around the clock, giving you cleaner structure and continuous liquidity. Track your round turn costs, exchange fees, commissions, routing to keep your P&L attribution accurate. For charting, keep it minimal. MES price, VWAP, and the 2 zones that matter the most. Too many indicators hide the price signal you're trying to see. Now, the part that can wipe out months of profits if ignored. Trap 1. No hard stop. If your stop only lives in your head, it's not real. Enter, and when the price moves in your direction, then you can place the stop to break even if that was your original trading plan. Trap 2. Misuse leverage. You don't follow your risk per trade and you over leverage. To prevent this, use your sizing formula and respect your daily loss cap. Trap 3. Overnight without rules. Headlines hit when you sleep. If you need to hold the trade, cut size, time limit the exposure, and use a hard stop. Trap 4. Thinking size changes risk. MES trades the same structure as ES. Small notional doesn't mean safer. Discipline stays identical. Let's look at a simple example setup, not a signal, just structure in action. So first of all, we mark off support and resistance zones. Here we had price traveling in a range and it broke the support and treated it as resistance. Next, you define your risk and your target using the calculator before entry. Our risk would be above this wick here and our take profit would be at located liquidity zones. Now, if you were to put the entry at the retest of support as resistance, with the stop loss above the wick and the take profit near enough the liquidity zone, you would have had close enough to a 6R on the trade. If price moves in your favor, scale out part of the position and let the rest trail behind structure. The goal here isn't to predict, it's to show how a clear process looks when applied. This is an example trade, don't copy it. Structure and discipline scale across any trading style. The charting setup and tools that I use are linked below. You've seen how structure, risk, and how the whole process fits together. But MES isn't for everyone. Let's define who it actually serves and who's better off avoiding it. It's a good fit if you're learning how futures behave, managing a sub $10,000 account, and focused on preserving capital while building skill. Bad fit if you don't understand leverage, you refuse to use hard stops, or you're chasing lottery style trades. The bottom line, MES isn't about excitement, it's about control and precision. When you respect that, your decisions get simple. Continue here, it builds directly on this video.